Does this sound like someone you know?
There's no way I can invest now. Prices are too high.
You know what? I think I'm gonna wait for the market to crash.
There's no money to be made in real estate right now.
If the answer is yes, then you need to try Investinol. Just 2 tablets a day will stop you from having excuses, negative attitude, no deals, no money, and poor credit.
And don't take my word for it. Just listen to Gary from Texas.
Before Investinol, I had no deals and no cash flow. Now, I got 2 deals and cash flow every month. Thank you so much, Investinol.
But seriously, guys, there's so many reasons to invest in real estate today that I wanted to share some of them with you and remind you that despite the market, despite the proposed laws to the 1031 exchange going completely down the toilet, that there are still some great reasons to invest in real estate. My name is Mike, and if you're new to my channel, welcome. I make videos about making money in real estate and personal finance. Today is all about tax write-offs, so let's get into it. Real quick, guys, lately I've been into trading stocks and crypto, and I've been having a lot of fun on the Webull app. So if you're interested in getting set up with them, click the link in my description below and get signed up today. If you do, Webull will hook you up with 2 free stocks with a deposit of $100 or more. Now, as we all know, taxes are our biggest burden when it comes to making money in real estate and building wealth. This is why many turn to real estate investing as one of the best tools for growing wealth over long periods of time. As some of you may know, there are many ways to make money in real estate. Owning real estate is more than just collecting rent and cash flow each month. One of the best advantages of real estate is the tax write-offs associated with it. In real estate, a return or a profit can be calculated in so many different ways. For example, you can make money every month but still show a loss on paper at the end of the year. This, of course, will reduce your overall tax obligation. So here are some of the tax write-offs that make investing in real estate so great. First up is the 1031 exchange. In my last video, I went over some of the possible changes that could be coming to the 1031 exchange very soon. But since those changes have not occurred just yet, the 1031 still remains one of the best tax advantages for real estate investors. What this tax code allows for is an investor to sell a property and then purchase another property of equal or greater size and roll those capital gains into that next property tax-free. This will help you defer your tax base on the sale of that property and help you grow your wealth. This is a great wealth building real estate strategy because you can definitely defer your taxes as long as you either never sell or when you do sell, you trade up to another property and do another 1031 exchange. Even after you die and pass away, as long as your will or your estate is set up correctly, you can pass the real estate down to your heirs and they can continue to do the same thing, indefinitely deferring the taxes owed on those capital gains from all those sold properties. Next up is capital gains exclusion on a primary residence. Did you know that as long as you've lived in your home for 2 out of the last 5 years, then you can sell your property up to $250,000 higher if you're single, $500,000 if you're married, without paying any capital gains tax on the sale of that home. So even if you lived in a property and sold every 2 years and bought in the right areas, maybe fixed up, forced appreciation, and then sold and kept repeating that process, you could actually build wealth just using your primary residence. Not a bad deal. The third way is taxable income. Rental income from real estate is not taxed at the self-employment income rate of 15.3%. This, of course, will depend on how you hold your property, meaning if you own it solely just yourself or if you have your property owned and structured in an LLC or some type of corporation or a trust. Each of them has different rates that apply, so be sure to look at your local laws and consult with a CPA or real estate attorney before you act on that. Number 4 is mortgage interest write-offs. On a primary residence, the mortgage interest up to your first $750,000 can be a write-off, saving thousands of dollars in taxes. On a rental property, any interest that you pay on the mortgage can be a write-off against your rental income for that year. Depending on where you own property and what state, your mortgage interest could be a large chunk that you could get written off from your rental income. So this is actually a really good thing. Number 5, property taxes. This is another deduction that you can write off against your rental and personal income. For primary residences, you can deduct the first $10,000 of your property tax against your personal income. And for an investment property, you can deduct 100% of your property taxes against your rental income. Again, depending on what state or municipality you are in, those taxes could be pretty high or pretty low, but it's also nice to know that you can write this off. Number 6 is a cash out refinance. Did you know you can refinance the extra equity in your property and pull it out tax-free? Technically, it's a loan you must pay back, as you're borrowing the existing equity and using that money without paying taxes on it as it hits your account. This can work on a primary residence, but it does work to your advantage on an investment property, as the new mortgage you pay on the amount pulled out against your rental income. This allows you to use the money for whatever you want, but hopefully you reinvest it back into the property. And last but not least is depreciation. Depreciation occurs over long periods of time and shows as a loss on paper, which is actually a really good thing. This puts money back into your pocket in the form of reduced taxes. With rental properties, you're allowed to depreciate them over a certain period of time. Typically, it's about 27 years. Eventually, the cost that you depreciate will need to be paid up in full at the time of sale, unless, however, you go back to number 1 and do a 1031 exchange. So while eventually paying tax on a depreciating asset isn't fully unavoidable, but it does work good if you plan to keep the property and then do a 1031 exchange. So guys, speaking of tax write-offs, if you're trying to do YouTube professionally and want to improve and grow your channel, then I suggest you check out VidIQ. It's a great tool for growing your channel. They provide you with a lot of tips, tricks, and analytics so you know what to work on to maximize your channel's reach and get the most views possible. So if you're interested, click the link in my description below. So if you got value out of this video, consider following me on Instagram, and please do me a huge favor that is also an investment. Pound that like button, smash that subscribe button, and click that notification bell for me, as it helps my videos reach newer eyes every week. It really means a lot, and it costs you nothing to do so. Thanks guys, I'll see you on the next one.